If you've been trading Forex for a while, you've probably heard people say that candlestick patterns can reveal what the market is about to do next. And honestly, that's not far from the truth. Candlesticks are one of the simplest yet most powerful tools traders use to understand price action. Once you learn how to read them properly, you start seeing the market in a completely different way. One of the most popular candlestick patterns is the pin bar. This pattern has a long wick and a small body, and it usually shows that the market tried to move in one direction but got rejected hard. For example, if price pushes down and leaves a long lower wick, it means buyers stepped in and forced the price back up. Traders often look for this pattern near key support or resistance levels because it can signal a potential reversal. Another powerful pattern is the engulfing candle. This one is pretty straightforward. A bullish engulfing pattern happens when a large bullish candle completely covers the previous bearish candle. It shows that buyers have taken control of the market. The opposite is true for a bearish engulfing pattern, where sellers suddenly overpower buyers. When this pattern appears after a strong trend or near a key level, it can be a strong signal that momentum is shifting. Then there's the morning star and evening star patterns. These are three candle formations that often appear at the end of trends. A morning star typically signals a bullish reversal after a downtrend, while an evening star suggests a bearish reversal after an uptrend. What makes these patterns powerful is the shift in momentum that happens between the three candles. You see selling pressure fade and buying pressure start to take over, or the other way around. Another pattern traders watch closely is the doji. A doji forms when the opening and closing prices are almost the same, creating a candle with a tiny body. This usually means the market is indecisive. Buyers and sellers are basically fighting for control, and neither side is winning yet. When a doji appears after a strong trend, it can be a warning sign that the trend might be slowing down or preparing to reverse. Now, here's the thing. Candlestick patterns on their own are helpful, but they become much more powerful when combined with other tools like trend analysis, support and resistance, and confirmation signals. A lot of experienced traders also use trading systems that help scan the market for these setups automatically. For example, some platforms include tools that detect trends, analyze signals, and manage trades so you don't have to stare at charts all day. That's where tools like the Trading Management Solutions EA can quietly help in the background. It can scan multiple pairs, generate trade signals, and even manage risk with features like trailing stops and break-even settings. So while you're focusing on learning patterns like pin bars or engulfing candles, the system can assist with the technical side of trade management. At the end of the day, mastering candlestick patterns isn't about memorizing shapes. It's about understanding the story behind the candles. Every wick, every body, and every formation is basically showing you the battle between buyers and sellers. Once you start reading that story clearly, your ability to spot high-probability trading opportunities improves dramatically.